CNBC TV18 and IndiaBonds present Bond Street.
Welcome to Bond Street. India's bond market is a huge $2.8 trillion engine that influences everything from government spending to corporate growth. Yet it remains underexplained. Bonds are one of the simplest ideas in finance. A company or a government needs money today, so it borrows from investors. In return, it promises to pay interest regularly and return the principal on the date of maturity. Well, that's it. There's no complexity. Just a loan with clear terms, timelines, and responsibilities. Now, for investors, bonds play a completely different role and an equally important role. They offer stability, predictable cash flows, and lower volatility than equities. And depending on the rating of the issuer, bonds are also able to offer different layers of risk and return for investors to choose from. Now, this show, Bond Street, is a partnership between IndiaBonds and CNBC TV18 to achieve one goal: to make bonds visible, accessible, and understandable for every Indian investor. Let me introduce my guest today, Vishal Goenka, co-founder of IndiaBonds. He has over 20 years of experience in global fixed income markets, experience having held leadership positions in Deutsche Bank, Singapore, and in Merrill Lynch, London. Vishal, thank you very much for joining us.
Thank you, Latha, and I really appreciate calling me here.
Okay. Well, let's start by first explaining why are we presenting Bond Street now? What is this growth you are seeing in the corporate bond market?
I think the growth in the corporate bond market is a function of how the economy has shaped up, right? So we are a $4 trillion GDP economy right now. What I think spurred this was few things. One is lack of, if I see headline Nifty, lack of equity performance in the last 12 to 14 months. So once you have created wealth, we realized people said, okay, I'm going to preserve this wealth now because now we are a richer nation and I've created this wealth and I get 6% at FD, so can I go and get bonds? The second thing is the interest rate cycle. As we know, it moves in 3 to 4 years. So when RBI started cutting rates, an expectation of more rate cuts, as globally, people said this is a good time to get into it, right? So I think that education and awareness that I've created some money now, the wealth has been created, and equity is not giving me much returns. Let me try and preserve and earn 8 to 10%.
Which made 2025 a kind of a year for bonds.
Absolutely.
Okay. Give us some numbers. I mean, what kind of growth have you seen? And what kind of growth you think we can? Yeah,
so just to give you some numbers, in the secondary corporate bond market, last year we had 11.9 lakh transactions. This year, in 7 months, we have 11.7. So the market is set to grow at about 80 to 90%, which shows you how retailization is going on. Even this volume in the secondary corporate bond market last year was $200 billion. Now, the corporate bond is a $642 billion market, and that $200 billion was a 25% growth from the year before. So I do see a little fundamental change that's going on, and it's not only the large players, but, HUFs, individuals, small corporates, everyone's kind of saying, okay, let me balance my portfolio. And maybe, people were always invested in fixed income. Fixed deposit was a proxy. And there's like, you know what, I can earn 3 to 4% more if I do corporate bonds directly.
Okay, so you are seeing that realization growing.
Absolutely.
You have worked in Singapore and London. How are the Indian bond markets, especially the corporate bond market, different from the markets there?
It's completely different. I get that question all the time, especially with what's happening in India and the retailization. They're like, what happens in the US? What happens in Europe? We are dramatically different. So a bond notional size globally is $200,000. So roughly about 1.7 crores to buy a bond. Some fractionalization has happened in the US. You can buy for $10,000. In India, due to new regulation, we moved down from 10 lakh rupees to 10,000 rupees. So you can buy a bond for $110 and not 200,000. Vastly different than how markets are. And I think that is what is leading to the democratization or retailization of the bond market. That is one significant difference. We have a lot of things which are very, very different. The EBP, the electronic bidding platform, I do not see that anywhere else in the world. That brought about transparency about 10 years ago as to what is the pricing corporate issuers are going to get. And finally, the online bond platform regulation, which came in November 22, set the tone for the growth that we are seeing right now.
Yeah, I was coming to that. The inflection point for the equity markets. I mean, equity markets are in the DNA of Indian investors
Absolutely.
for some time now, at least for
Last 6 years. Yes.
regions and categories, it's even more. But it got an inflection point when digitalization made it easier.
Absolutely.
Are you seeing that in the bond market?
So, digitization or technology is an enabler. I mean, I say that fixed income is the last bastion to be conquered by technology.
Exactly.
Right? And we see that happening in 3 ways. One is about information dissemination. 3 years ago, I said, go, Latha, buy a bond. You'd be like, where do I start? What are my options? What is the coupon payment? What is the rating rationale? Today, thanks to OBP, all this information is mandatorily has to be available on every platform. So information is available. We are creating a lot of education and awareness, including a partnership like this, where we can amplify our reach. And that's thanks to technology, right? You don't have to go and tell people about bonds, you can see it. Second is about access. You wouldn't know how to buy a bond, but today, let's say on a platform like IndiaBonds, you can do KYC in 3 minutes. You can buy a bond in 2 minutes. And it is even more secure than the equity market because the payments technology that's been developed along with all the market intermediaries, when you buy a bond, your money goes straight to the clearing corporation, doesn't go to the broker.
Okay.
So there's no pool accounting and they transfer the security. So really, really very, very secure. So it builds kind of transparency in the market. When you can see the prices every day, you can access it in 2 minutes. And that's how I think technology is rapidly changing bond markets for individuals.
And is there also the same kind of availability of prices and real-time changes in prices, all that available on platforms?
Yes. So pricing is something, from being completely opaque. Now, you can compare prices across bond platforms. You have some
you get
kind of
end-of-day prices?
Yes, you do see. So typically the corporate bond market is not that volatile, as you know, because the underlying government security
market doesn't change for weeks sometimes.
Exactly. It moves 2 to 3 basis points. So even only the AAA segment can kind of, mirror the government security move. But if you go down to a AA minus, a single A kind of a paper, prices are not that volatile and they kind of remain the same, but you can see them every day and you can compare prices. I mean, today there are 50 platforms who have OBP license, not all are functional, but you can go compare prices.
Okay. So you would attribute the rise in retail participation to this digitalization? To what would you attribute it and how do you see it growing?
So as I said, I think the rise of retail participation definitely due to digitization, access, information. I think largely also to regulation, this positive regulation. And I said, the economic cycle that we are in, people realized they made a lot of money in equity investment and not so much and pretty volatile last year. And they said, okay, wait, hang on. I want to save my money, but I can save by earning more and I didn't have that potential. So technology is enabling, powered by regulation. Okay.
Let me come to what we are trying to present on IndiaBonds. What is the kind of education investors need?
So when we started this journey, it's very basic education. Like people ask me, Vishal, what is a bond? And I'm like, okay, bond is a loan, as you said, to a company or a government. So I think that education and awareness in nomenclature. So people get confused, what is yield to maturity? Yeah. I'm like, the word yield in English dictionary means returns. That's it. So yield to maturity is if you buy a bond and hold till maturity. So things like that, how does price and yield work is what we need to explain. And on our part, we've done about 50 webinars, educational webinars for the masses. We've had CXOs and CEOs on webinars present when they're doing a bond issue. We've tied up with NISM, which is a SEBI initiative, and I teach students every month. We get about 1,000 plus students talking about this. So I think that kind of education awareness is important. And then there's digital consumption, right? You write blogs, you do podcasts, and the basic education, what is a bond, is very, very important. The last data, I think NSDL used to present this, only 3% of demat account holders actually invest in bonds. So I see that as an opportunity.
Absolutely. Yes. The nation should see it as an opportunity. Yes. As a child, I remember, as a teenager, I remember advertisements of Sundaram Finance bonds. Many of the southern NBFC companies used to give 14, 15%. Those were the big days of high interest rate. Yes. And that was conversation at the breakfast table that you're getting so much money. Even, when I spoke to friends who invested in debentures, debentures and the interest would be traded, could be traded separately, the COCA.
Yes.
It was an evolved market.
Yes.
What caused its downfall and what gives you hope?
I know it was an evolved market because I think the level of interest rates are very high.
Yes.
If I look traditionally into any emerging market, if I take a 25, 30-year view, it starts with very high interest rates. Like look at Korea, right? 30 years, finally interest rates keep going down to 1.5%. But you stole the thunder a little bit by saying that breakfast table, because I was going to say that bonds have to come to mainstream dinner conversations again. Yes. It is about, hey, I've made a lot of money in equity, but 20% of my portfolio should be in fixed income, which bond to buy, right? So the risk return has to justify. When your base rate, which is, let's say, repo at 5.5% and public sector banks at 6%, people want to make more money. A difference of 3% compounding effect in 10 years changes your returns by like 70%. This is pure maths, right? So this is what the effort is, that, when people sit in front of the television and CNBC saying, okay, what are we going to buy today? Which bond are we going to buy? We have some spare money. My salary has come in. I want to save. I do not want to put in higher volatile assets. Which bond should I buy?
Okay. Well, let's take a break on that note. Yes. Thereafter, let's discuss the challenges to the bond market so that we can look for solutions as well. Back in a minute.
Fair enough.
CNBC TV18 and IndiaBonds present Bond Street. CNBC TV18 and IndiaBonds present Bond Street.
Welcome back to Bond Street. We have been discussing with Vishal Goenka, the co-founder of IndiaBonds, what are the advantages of getting into the bond market and what he sees as prospects for the Indian corporate bond market. Vishal, thank you very much for your patience. Well, you've explained why investors should do asset allocation, why they should be in fixed income as well. Can we now look at the challenges?
Yes.
What's keeping investors from coming into the bond
So
market?
I think one challenge, as we highlighted, was awareness, and that's what we're trying to build. But there are certain risks which I think investors should be fully aware of. The primary risk is, as it's a new industry for retail, just make sure your investments are from a regulated platform. There are, 3 years ago, there were a lot of websites with selling fixed income products which were not regulated. So secondly, make sure you buy listed bonds. So all regulated entities can only sell listed bonds. Unlisted bonds means there's no disclosure. The company can choose not to tell you about its financials. It's your money, so you need to read upon that, right? So credit ratings is a good first smell check. That is it a double A, it's a single A. For the common man, credit ratings is the CIBIL score for a company, right? So check that. Rating rationale reports and reading about the industry, I think, is very important. So for a newbie to start investing, just get some hygiene factors going. And maybe start with a double A or a government security to learn what's going on before you move on to the high yield side.
Okay. And what should be the compelling reason to invest in bonds?
There are basically only three. One is you get regular income, you get fixed returns, so you don't get that much volatility, and you have to diversify your portfolio. Because globally, when we talk about asset allocation, we talk about equity and fixed income. So, highly advisable that everyone's financial portfolio should be 20-25% on fixed income. I'll give you an example. We plotted Nifty headline gains for the last 4 years, and headline to headline was 43-44%. Now, if you had invested in a 10% bond 4 years ago and reinvested the coupon, you would make the same number.
Okay.
And if you invested in Nifty last year, you're probably up 3 to 4%, but your 10% bond would have still given you 10%. So you diversify your portfolio to weather volatile storms of more risky asset classes.
Speaking of this 1 year loss and 1 year gain,
Yes.
the big difference for a fixed income investor versus his own equity portfolio would be that the gain in equities within 2 years is taxed only 20%,
Yes.
whereas it is slab rate when it comes to bonds.
Yes.
Do you think policy is discriminating and that has soured interest?
No, so there's been a long drawn debate around taxation and treating asset classes equally, right? So from an investor's point of view, and if we want to encourage fixed income investment, which is lower volatility, I think that some kind of equalization should happen. For example, we recently introduced a TDS in fixed income. Now, that completely jeopardizes calculation of IRR, right? So the humble request through white papers and discussions are always to equalize tax treatment and treat fixed income also separately, right? A person wants 7 to 8% income. Let's not do TDS. Let's equalize on gains. I am with you there.
Okay. Well, my hunch is that as we became a younger demography, we are talking about demography, younger people are willing to take the risk, and probably that's why the attention shifted away from debt. As the demographic dividend equalizes, maybe the interest in fixed income will return. Okay, what is your one piece of advice to a young investor who will give you this argument that I have my whole life to wait, let me take a risky bet rather than a safe bet? Why should I be in a safe instrument?
Well, the analogy is that if you don't have any money left and blown up by volatility, then you have no game, right? So, again, it's not either or. A balanced portfolio, you might have a job loss suddenly and you're like, oh my God, what am I going to do? But okay, I've got some money coming from fixed income. You want to buy a motorbike in 3 years and you want to save up for that. You want to buy a house. You have a kid to send to education. So life goal targeting through fixed income instruments giving you 7 to 10, 11% are very, very good.
Okay. All right. Why don't you educate this young investor for us who has come in and then who realizes that it is very easy to invest in equities? What would you advise them in terms of how to go about and why to go about investing in bonds?
So one thing is I'll say it's as easy to invest in bonds
as in equities.
As in equity. But financial education starts at a young age, and I'm very happy that the younger demographic is getting financially aware. I'm also actually, the last year's sobering effect equity markets have had will tell people to study further about portfolio balance, right? And again, coming to first principles of finance, when you get financially aware or invest, there's a SEBI survey just released that 80% of Indian households are actually averse to risk. 21% want to start financial investment, and the best thing is to start with fixed income because it's stable, it's regular, get used to what a demat account is, what a KYC is, and it's a great first step to take for a new investor.
Equities are seen as interesting chatter.
Yes.
They are sexy, and bonds are seen as boring.
Yes.
What would your advice be to regulators, media, and the investor to, correct this perception, which I think is a wrong perception, by the way?
I think boring is beautiful, right? So if I can sleep at night and get 10% every year for next 4 years and not get into the volatility, that is great, right? My perception is that, there's so much chatter about equities, which technically is a higher volatile, higher return asset class. Why do we regulate fixed income so much? 3 years ago, you could not buy a bond under 10 lakh investment. Now, thankfully, it's come down as low as to 1,000, 10,000. So I think we have a proactive regulator looking at these things. But some bit of boring is great. You can't have a party or, live on very high highs if market is going up or really, really depressed. And you know that, hey, listen, 20% is in fixed income. I'm okay. Some money is coming in.
Okay. Is the information on bond as easily available? Do you get to read, how would a lay investor get to read about credit rating changes or, a company's interest payability going down for whatever reasons?
Yes.
A lot of newspapers and media houses focus on every turn in the equity or earnings analysis. There is less attention to this. How will an investor learn?
So, Latha, very humbly, disruption and revolution takes time. And, if I compare from last 1 year, a lot of financial media like yourselves, digital media have started writing about fixed income, especially also about after global index inclusion, right? So on a platform like ours or other online bond platforms, there's a lot of education material, podcasts with some CXOs, there is education, there's training material for people to learn up. And then it is about, this industry is about feature creation. For example, on IndiaBonds app, we introduced AI because an information memorandum is 100-page on a bond document. What are the covenants? And people are like, how do I grapple with this? And we introduce AI for all IMs. Like, if you want to ask what are the covenants, you just push a button and it'll tell you what the covenants are. So technology is enabling this information dissemination. We are very soon introducing live market news. So if you are invested in a bond, you will get a ping if rating changes, if results come out. So it's like equities have a 16-lane superhighway of technology and information. We are on a 4-lane highway going to an 8 very soon. But as more people come into this, I think this industry will get its own commercial revenue investments to grow further.
Okay. You know, the mutual fund, debt mutual fund,
Yes.
up until 2015, the AUM of the debt fund was higher than the AUM of the equity fund. After we came into COVID, you know,
Yes.
2020 and thereabouts, when interest rates fell so much and equity started looking much better, we see a U-turn.
Yes.
And equity AUMs outstrip debt AUMs. Do you think that correcting the, taxation in favor of debt would be, a way to make more people educate their investors on debt?
So I think the whole equity positive environment we've seen the last 4 years is not only an Indian phenomena, right? So we're talking about S&P, NASDAQ, and we can go into macroeconomics about the infection of, liquidity injection by global investment banks. In 2008, S&P corrected 35% over 14 months. In COVID, 3 weeks, right? So there's huge money still sloshing around. And I think as digitization happened, people locked at homes, they said, hey, this is quick money. And that's why the whole equity culture came about. That's why the whole SIP culture came about. And in mutual funds or debt mutual funds, obviously the indexation benefit going away, it's still the jury is out.
Became a perfect storm.
Yeah, the jury is out why and what. I'm not going to get into that. All I'm going to say is that, as we go richer as a country, right, from 4 trillion, we go to an $8 trillion economy, the capital creation in the economy has to come from credit financing,
yes.
right? I just saw a comment by Honorable SEBI chief that the credit creation actually has moved away from the banking sector and some of it has been picked up by capital markets. So the concentration risk of credit in the banking system is not there, right? It's diversified. Today we have AIFs who's taking some credit risk, retail investors, FPIs, and that's very healthy for our economy to grow to 7 to 8.
Oh, absolutely. Finally, what do you want viewers to take away from our future editions of Bond Street?
Well, I think future editions we spoke about should be a dinner conversation. We should demystify the nomenclature that is around. We should talk about corporate bonds. We should talk about rating upgrades, downgrades, public issuances, and just spread, more kind of information and knowledge. Okay. But the final would be, and probably is the name is Bond, and much like the character, offers stability and security.
Oh, good. That's very, very welcoming and inviting. Thank you very much, Vishal Goenka. Thank you very much for watching this show, and in future editions, the effort is to demystify the bond market to make them accessible and understandable to the lay investor. Thank you very much for watching this edition.
CNBC TV18 and India Bonds present Bond Street.